Stocks closed at their highest level of the year to end last week. We're entering one of the most interesting seasons on the stock market, and everyone said goodbye to a giant. I'm Daniel Schwarzman, and this is The Long and the Short of the Market, a weekly video about the stock market and how to put it into a broader, longer term context. Subscribe to get more of this on YouTube at youtube.com/@shortinvestingguy. Last week, the S&P 500 closed at its highest level of the year, nearly 4,600. It's crossed that level in intraday trading, but hasn't finished any day as high as it did last Friday. The NASDAQ is almost at its highest level of the year on a closing basis, and the Russell 2000 is well off its highs, but the small cap index is up nearly 14% since its low of October. As often happens when we get to an extreme with a long series of winning streaks, a lot of funky stuff is happening too. We saw a lot of the junkier names in the market do really well last week. GameStop is still a stand-in for the big meme stock craze, which has its aftershock still plumbing. It was up nearly 25% last week. Plug Power, a junkier energy speculative sort of company, was up over almost 31% last week. Another name in this category, Virgin Galactic, which flies people through the bottom levels of space and doesn't make a lot of money, up 11% last week. The Financial Times has an index of highly shorted stocks, which tend to overlap with these junky names. It was up nearly 11% last week. Just a sign of what's going on. That could mean nothing. It could just be a symptom of people are being bullish about the stock market, and they have reason to be bullish, you could argue. GDP report came in really strong in the US. Inflation is diminishing around the world, a sign that perhaps we have beaten the inflation problem of the last year to 18 months. And meanwhile, earnings have been just fine in the US, no major craters in the earnings season. And it could be that the Fed and central banks around the world have achieved the so-called soft landing, where we managed to wrestle down inflation without strangling the economy as a whole or forcing a serious recession. I don't have an opinion on any of this. I don't really know what's going to happen. S&P 500, according to the Wall Street Journal, is trading for 20.4 times earnings, both this year's and next year's, which is not cheap. It's also not insane. Puts us in a very interesting spot in the market. It's an interesting spot for another reason as we begin our first full week of December in the market. Reason is because December is one of the more interesting seasons of the year. I generally don't believe in seasonality from a stock trading perspective because there's a lot of noise, and if everybody knows something's going to happen, that pattern tends to go away. Sell in May and go away, for example, or even the Santa Claus rally that you're going to hear about in a little bit. But one thing that is real, for two reasons, one that's not so reasonable and one that is the effect of the year end. The reason that's less reasonable is that mentally, when we get to a new year, we turn the page. It's just how we are as humans. It goes back to our roots, probably, to following the sun, the journey of a year, whatever. A year is a real thing, and we tend to think, okay, now there's a new year, things are going to change. It doesn't mean that if I own a company on December 29th, the last day of this trading year, its prospects are going to change in any way between then and January 2nd, the first day of the next year. But we do think that way sometimes. And it's worth knowing that mental effect because you're going to feel it too as an investor. The more fundamental reason, though, is tax loss selling or tax loss harvesting, a strategy that people often use to minimize their taxes and that can often lead to interesting opportunities for other investors. Let me talk a little bit about what that is, why one might use or not use this strategy, and then how we can use it to our benefit even if we are not tax loss harvesting or tax loss selling. We pay taxes on capital gains. That's what I'm focused on right now. We pay taxes on dividends too, but ignore that. Taxes on capital gains. In the US, this matters in two ways. There are two things that we have control over. One is short-term gains versus long-term gains, and the other is the fact that we pay on net capital gains. Short-term versus long-term, meaning if we own a stock for more than a year before we sell it, we pay a tax on the gains on how much more we sold it for than we bought it for, but we pay under a capital gains tax rate instead of as a normal income. If you have it for less than a year, you pay as if you made money any other way by working or whatever else. It's just normal, ordinary income. But if you hold on to it for more than a year, it gets into a capital gains tax rate, which is usually lower for most Americans. That makes it so that it's logical to structure investment strategies, at least to some degree, around longer term investing. Personally, I think there are a lot of better reasons to think about investing for more than 1 year at a time, but the tax is a nice bonus. The fact that my strategy of holding stocks for 2, 3, 4 years or longer, if I do well, is also going to be tax efficient. That's great. That's a bonus. At the same time, we pay on net capital gains, meaning if we have one stock in our portfolio that makes $2,000 and we sell it, and we have a $2,000 gain, and we have another stock that has a $2,000 loss, if we sell that, these two offset each other and we end up not paying any capital gains in that tax period. The idea being, why I'm bringing this all up, is that in December, where we're getting towards the end of the year, people might be encouraged to sell their losers to lock in losses that will offset their gains. They have to sell and then keep the stock out of their portfolio for 30 days so that the loss will register, and then that becomes of value to them. So an otherwise lost cause might bring some good. I'm not bringing up this strategy to advocate for it. All things equal, and I should confess, I do use this strategy, but all things equal, if you're thinking about your tax situation first, you're going to make mistakes. In other words, you will probably lose more money by focusing on a tax optimization strategy than you would just owning stocks for whether they're worth more than you are paying for them or less than you're paying for them, depending on the situation. Let me give you some examples. Usually I get hurt more by trying to hold on to stocks for at least a year, and it turns out they spike really early, and all of a sudden I could have sold them for higher, but then they go back down by the end of a year. And now, great, I'm paying less tax, but I also made less money. But even with the tax loss harvesting, I tend to be in situations where I sell off a stock and I end up losing money as compared to what the alternative would have been. On December 30th of last year, the last trading day of 2022, I sold a bunch of shares in Kimball International, a furniture company. I've talked about them before. If you remember me talking about them, you'll know that in March of this year, they announced they were getting bought out. I sold the shares last year for $6.39. When I sold them after the news that it was bought out, it was for basically $12 a share. That nearly double that I missed, the $5.61 that I missed out on, would have been way more valuable to me than whatever tax loss benefits I got last year. I tried this in another way this year where I sold a couple stocks in January. One of them was Arlo Technologies. I sold about 22% of my position in one portfolio, with the idea being I'll lock in the tax loss early this year, not when everybody is selling it off, but when it's already starting to recover a little bit, when there's not so much pressure on it. That way I'll get a slightly better price, but also be able to lock in the tax loss and have more flexibility at the end of the year. I sold those shares at $3.86. Arlo ended up going up to over $11.50 a share at some point this year, and is now at over $9.50 a share, or about $9.50 a share as I record this. That's 150%, which is way more of a gain than I would have got from that tax loss. Again, I would have been better off just holding on to the shares. On the flip side, I sold shares in Wolverine Worldwide, a shoe retailer, in January at about $15 a share after it had recovered quite a bit at the beginning of the year. And then I ended up selling the rest of my shares in the company at $8.30 a share in September, when its year wasn't going well and it was clear that I just needed to move on. Shares now are around $9 a share, which is to say that the future is unknowable. So it's not that as if I should never sell a stock. There are good reasons to sell stocks, whether to take a hit on tax or not. It's just that I should be focused first on, is this company worth holding on to? Should I continue to hold shares? Should I buy more shares? Should I get rid of shares and so on? That should be my focus, and not, can I lock in a tax loss? Can I optimize my tax strategy? If you're focused on taxes, the tail is wagging the dog a little bit. You have to ultimately pay taxes. I'm not saying that, but focus most, in my view, on does it make sense to hold this company? Does it make sense to buy more shares? Does it make sense to get rid of it? That should be the first step. And then the tax loss harvesting, it's only a secondary or tertiary concern, really, after you decide whether you want the stock in your portfolio or not. The reason I'm interested in all of this, though, is that because if other people's tails are wagging their dogs, that could lead to an opportunity for us. Meaning that if they are selling off their losers to lock in a loss, maybe they're selling them for a price lower than what they should be. Because at that point, lower is almost better. The loss becomes wider. You're getting more of a tax benefit. So if you've given up on a stock because it's been a loser, because you're tired of it, and then at least you can get a tax loss out of it, you're a little bit less concerned about the price, which can lead to bargains for people who have the patience to wait for things to turn around. We should caveat this, of course, that losers are losers often for a reason, but there are times where a stock will be a loser for short-term issues because the market is only looking at the last 3 months and the next 3 months and not at any longer term, or just because there's a trend, whatever else, and that if we can get in at that time, we might have an interesting situation. I've already done a video about Duolingo, which was a tax loss seller candidate last year, and which since has more than tripled, I believe, from where it was last December, which I missed out on, and Spotify, which I did buy, and which has more than doubled from where I bought it last December. That's an example of where their long-term story hadn't changed at all, but in the short term, because of how tech was trending and so on, things went really poorly. That's an interesting area for people to look for this year, not for a couple of reasons. Not only because you might find an interesting opportunity, which is idea number one, and which should be our drive and motivation most of the time, but also because it's always interesting to understand what went wrong. Why is the stock doing poorly? What do people know about it? What are people right about it? What are people wrong about it? And then see how that plays out. Where we're interested in the stock market is where things get exaggerated, where things go too far in one direction or another, which leads to a difference between price and value. I have a stock that I've started buying that I think falls into this category and reminds me quite a bit in some ways of the Spotify Duolingo cases, but I don't want to talk about it yet because I'm still buying it. I'm still analyzing, trying to wrap my head around. But here's another stock that'll illustrate this example. J.M. Smucker. J.M. Smucker, ticker symbol SJM, is a food company. It is the owner of the brands Jif, the greatest peanut butter in the world, my opinion, but also fact, Smucker jellies, Uncrustables, Folgers coffee, Dunkin's coffee for the home, i.e. for K-cups and for whatever else in the home, and most recently, Hostess, which means stuff like Twinkies, cupcakes, and Voortman's, another brand that Hostess Brands had bought. The reason that J.M. Smucker is interesting right now is because it is close to 52-week lows. It has sold off quite a lot since it announced it was buying Hostess in September. The company announced the deal in September. It was trading at $141 a share, a little bit more. It's now around $111 a share as I record this, and was a little bit lower than that last week. That's a 20% difference. While it's often difficult to say with precision why a stock is sold off, it seems pretty clear that the market did not like J.M. Smucker's acquisition of Hostess Brands. They probably didn't like it because it was expensive. They paid a high multiple for Hostess's earnings. Hostess wasn't the most successful public company. It came public in the mid-2010s via a SPAC, special purpose acquisition company, before SPACs became a huge deal again around the meme stock bubble and the pandemic bubble in 2020 and 2021. And it grew reasonably on a revenue basis, but it struggled to grow its income and its operating income. Still, it was growing faster than J.M. Smucker and Hostess. Those are legendary brands. It's not a made-up company. There's another reason, though, that the market is concerned about J.M. Smucker beyond the price, which the price also means that J.M. Smucker is taking on a lot of debt at a lot higher rate than they were paying previously. That's a concern. But then there's also the concern that has to do with Ozempic and all the other newfangled weight loss drugs. These weight loss drugs that are interesting not only because they lead to weight loss, but because they're viewed as being able to strangle people's addictive desires. There's been reporting that it leads people to smoking less, to drinking less, and certainly to eating less junk food, which, whatever else you want to say about Hostess, it's a junk food company. J.M. Smucker wasn't so much of a junk food company before. Peanut butter is great. I am very biased about this. But now with Hostess in its portfolio, all of a sudden J.M. Smucker was prone to this risk, to this problem that these weight loss drugs might cause for food companies, paying at a high price, and the market wasn't crazy about that. So again, we see this sell-off. I don't yet have a strong opinion about J.M. Smucker. I think it's probably still not worth putting in my portfolio, and I have not put it in my portfolio. It's interesting, and I bring it up from this tax loss perspective, though, because it is close to its lows. It's interesting enough reporting earnings 2 days from when I'm recording this. Today is December 3rd as I record. It is reporting earnings on December 5th, which will be interesting. I'm not an earnings guy, but I think J.M. Smucker may have a good report here because they haven't released numbers yet on the impact of Hostess on their business. I think it closed the acquisition of Hostess faster than it expected to, which means it may see a bigger benefit from it this year than it's told analysts so far, which could lead to an initial positive reaction. But let's say that doesn't happen. Let's say there's a negative reaction for whatever reason, assuming it's not a new reason that you wouldn't be able to foresee. That could cause another spiral where people who have fed up with the acquisition, now seeing a loss over the course of the year and a price, if it gets below 100, it's going to be lower than it's been for 4 or 5 years. So most people holding J.M. Smucker who had seen gains for some period last year would now be seeing a loss. That might lead to tax loss selling, which might lead to irrational prices, which at a certain point gets interesting. Even at the current price, J.M. Smucker is trading at something like 13 times my estimate, which is a very loose estimate, but it's not adjusted the way that the sell side and analysts will use of what J.M. Smucker's earnings could be for the year ending April 2025. Say my number is anywhere close to right. If we see a further sell-off, all of a sudden this starts to become interesting. Since it's taken on a lot of debt, as it generates free cash flow to pay off that debt, the shares become more attractive. And I do think J.M. Smucker should be able to continue to support its what would be a more than 4% dividend if shares sell off. This is all just to say that's an example of what you can do with tax loss selling. You can find a way to look at a stock differently, to see an opportunity, and maybe if things get exaggerated in the next few weeks, you have a case where you might have to pounce on something that's interesting. How do we find these sorts of stocks? This is where screens are useful. You can look at stocks that are trading within 10 or 15% of 52-week lows. You look at other things. What I did for J.M. Smucker, I used a screen that allowed me to see stocks that have poor momentum, which I don't care about, but which reflects this sort of situation, stocks that might be at a tax loss selling position, but that have positive earnings revisions, meaning that their business seems to be earning confidence from analysts, suggesting a disconnect between the price and the fundamentals. There's lots of different reasons. EPS revisions could just be a reflection of the deal, for example. So there's a lot going on there that I don't want to oversell. But this is an example where a screen's useful. But also a random method. If you just pick an industry and then sort of scroll through it. I've been looking at the life sciences industry as something that's interesting to me. So scrolling through that, seeing where stocks, companies that are doing poorly, and then seeing what's going on with them. Are there good reasons? Are there bad reasons? Should they be long-term problems and so on? That can be an interesting way to get into this. A few caveats about this that I should throw out, or just added nuances. One is that as a fundamental investor, I sort of don't like looking at 52-week lows or highs. I look at them because you just want another way to look at stocks. But in theory, I should only be caring about what the price is today versus what the value is. Is the value higher? Is the value lower? Is the value where it is right now? My estimate of value should drive everything. I shouldn't care if the stock was here, but it got there from here, which would make it a 52-week high, or if it came from here, or if it's just been here. I shouldn't care about that. At the same time, we're human. We look at what other people do. We look at the crowd. We want to understand a story. Price chart can be the first way to get into a story to understand, are people excited? Are they not? I could look at the price chart of SJM. I could see that something happened in September. Then I look at the acquisition, I see what happened, and I can then start to figure out where to focus my analysis. That's the first thing that's worth keeping in mind. The second thing is that I'm talking about this in December as if all tax loss selling happens in December, but it's not on a schedule. It's not a clear clock that's going to happen. Some people anticipate this and start selling off in November for November effect, or they might be doing it throughout the year. I mentioned I tried to beat it by doing this in January. It's not going to be something that you can just look at your watch, look at the calendar and say, all right, now's the time to start looking. It's something that you always keep on your radar. But at the same time, as people's financial pictures for the year are much clearer in December than they would be in July or August, you might see more extreme selling as people try to get things in line so that they can reduce their taxes for next year. So don't expect this to be a literal thing that happens, but it's a good time of year to at least keep an eye out for it. There is a flip side to this, which the last thing, there's something, a so-called January effect, where you see sort of a rebound of whatever happened in the previous year. People lock things up for the year. They get rid of their losers, both for tax losses and so that they don't have known losers on their portfolio as they get released in the new year, especially professional investors. And then in January, they start buying again. January effects are often positive for the market. I don't know that it's fundamental, but we saw it in 2023 where a lot of companies jumped up in January and February. It looked like a junk rally, as I and my podcast co-host called it at the beginning of the year. But you saw companies like the Duolingos and Spotifys of the world already start to jump in those months. And then that ended up being just the first step to what was a really strong year for both companies. So just something to know that there's the flip side to this, the January effect. All that said, tax loss harvesting, something that I wouldn't over allocate efforts to in my own portfolio. And I'm trying to work on not thinking so tax forward with how I manage my portfolios. It is worth starting to dig around, looking for opportunities for stocks that have been left behind, whether you have to take action on them now or whether you just put them on your watch list and start looking at them deeper and deeper. A watch list is really important to maintain. And this is one nice angle to look at new names for your watch list. I've been enjoying doing it so far in the last few weeks, and I'm going to continue doing it through December. One more thing I wanted to hit before I wrap up is that, as many people following the stock market know, legendary Berkshire Hathaway vice chairman and longtime investor Charlie Munger died last week. Charlie Munger died at the age of 99, which may we all be so lucky to live so long. He was best known as Warren Buffett's right-hand man as vice chairman of Berkshire Hathaway. He had a more meaningful impact on investors over recent years as he became better known. He's known for his sayings, for being very blunt, very direct, very funny in the way he talked about the market and he talked about life, morals, and so on. I don't have any judgment of the man as a person. People who knew him praised him highly. He was a very rich man. Rich people tend to have their own peculiarities, but he seemed to be a man who lived in his views, who seemed to add a lot of value as an investor. As an investor, I can say he seemed to be a great investor. His biggest impact on Warren Buffett and on investors as a whole, I think, was to take them out of the post-depression mindset of Buffett's mentor, Benjamin Graham, where everything was about just trying to squeeze out little bits, the surest bets, and instead focusing on buying great companies at reasonable prices, which, by the way, is a very tax-efficient approach because you then try to hold on to those companies forever rather than cycling through cheap companies that you find every year. Munger's full of great sayings. One that I always liked was, tell me where I'm going to die so that I don't go there, meaning tell me the problems that are going to happen, and I'll do my best to avoid them in advance. He was a legend. He will certainly be missed by a lot of people out there. I was never a Mungerite or a Mungerhead. I didn't follow him with rabid attention, but he's somebody that every investor who's serious should study at some point, should understand how he thought, how he approached the market, because there are things that you will either resonate or that you can learn when you're doing your own investing. That's it for the long and short of the market this week. My name is Daniel Schwartzman. Thank you for watching. You can find more of my stuff on this YouTube channel at Short Investing Guide on YouTube. You can also check out shortinvestingguide.com. And I am also recently launched an investment advisory firm called Middle Coast Investing. It is a registered investment advisory firm. You're welcome to check out middlecoastinvesting.com if you want to ever get in touch with me, learn more about how I invest and whether that would be of interest. Thank you again for watching. I hope you'll see me next time. I hope to be doing this every week. So thanks again and talk to you soon.